Welcome to Talking Crypto. Today, we dive into the ultimate clash of asset classes, physical durability versus digital velocity. We pit the rental yields of fractionalized office blocks against the algorithmic returns of over-collateralized stablecoin vaults to determine where true passive value resides. Real estate offers tangible security, but it comes at a steep price. Property maintenance overhead, taxes, and illiquidity constantly drag down your net returns. On the other side, decentralized lending offers frictionless yield. But by dissecting smart contract risk, we see that digital velocity isn't without its own set of vulnerabilities. We expose whether the physical durability of brick-and-mortar assets can actually outperform the hyper-efficient velocity of decentralized lending. The answer might not be a choice between the two, but a convergence. Real-world asset tokenization is bridging the gap, bringing physical durability on-chain. By locking up value in over-collateralized vaults, decentralized protocols algorithmically guarantee returns without the need to ever fix a leaky roof. This creates a massive liquidity premium. Capital can enter and exit these markets in seconds, reacting instantly to macroeconomic shifts. The smart money of 2026 is building a hybrid portfolio. They use tokenized real estate for an anchor and stablecoin vaults for dynamic yield generation. We are redefining what it means to hold value. The foundation of wealth is moving from the dirt beneath our feet to the ledgers in the cloud. In the end, hyper-efficiency is winning the war on overhead. The era of passive income has been permanently upgraded by the blockchain. Be on the lookout for the full-length podcast coming up, where we break down the exact math comparing top real estate funds to leading DeFi protocols. Follow and subscribe to Talking Crypto. No influence, just news. Visit us at Talking Crypto app for more insights and our latest discounts.